This is the Value Investor Podcast with Tracy Reinick. All things value, all the time.
Welcome back, value investors. So I wanted to take today's podcast to talk about Berkshire Hathaway, the stock, what's going on at the company, and whether or not the premium that it seems to get because Warren Buffett was the CEO is now ending because he's not going to be the CEO as of January 1st, 2026. Now, a couple months ago, I did a podcast about whether or not you should buy Berkshire Hathaway, but that podcast was done before Buffett announced at the annual meeting that he would be stepping aside at the end of the year as CEO. Greg Abel, who right now is the vice chairman of non-insurance, is going to be taking the CEO job. And Buffett will remain on the board, and so he will still be giving his input, but the running of the day-to-day going forward in 2026 will be done by Greg. So that changes a little bit of the scenario, right? Buffett turns 95 this month in August of 2025. So this was not a surprise announcement. Anyone in their 90s, it's not a surprise, but it still kind of changes the psychology of why you would own Berkshire Hathaway, right? Because it has been for many decades because Warren Buffett is running it. And a lot of investors haven't even really cared so much about what the underlying businesses are. Like, what does Berkshire Hathaway even own? What does it do? How does it make its money? Some investors don't care. They only care that Warren Buffett was in charge. The returns have been outstanding, and the stock has beaten the S&P 500 for many of the previous years. So they just kind of overlooked everything else that was going on. But now the stock has weakened off of its all-time highs it hit earlier this year, and it hit those highs before the announcement that Buffett would be leaving the CEO job. So the question really has to be, are you willing to pay up for Berkshire Hathaway, for this company, if he's not running it? Are you willing to pay for the insurance companies and the energy and the Nebraska Furniture Mart, the See's Candies, the Dairy Queen, if he's not in charge? And what are you willing to pay for it? So, as I mentioned, the stock has come down off of its recent all-time highs. Some people were diving into it around Liberation Day because of the huge cash position it had. It was considered to be kind of like a safety play during Liberation Day, but now money is rotating out of that as the tariff fears have kind of abated a bit. And so it's just not as, a place to hide out right now, because basically people don't want to hide out right now. He still's got a huge cash hoard sitting there, but now that might be seen by some as an actual detriment if we're getting this, huge market rally. And for some, it might be seen as, place they can park their money and get better returns somewhere else. So over the last 3 months, Berkshire Hathaway B shares, which is brk.b on Zacks or /B on some other sites like Yahoo Finance, last 3 months, the shares are down 7%. The S&P 500, conversely, has rallied during that period and is now up 9.8. So that's a bigger spread than we've seen in recent years even between the two. And over the last month, it still is a spread, not quite as bad. The S&P is up 3.4 and Berkshire is up, but only 0.2%. It is off the earlier August lows, however. Year to date, Berkshire up 5.9%, and the S&P 500 now is up 10.2%. So it is underperforming a little bit year to date, when earlier around Liberation Day, it was definitely outperforming then. That's when it was, hitting the new highs, but it has not pulled back. Over the 1 year period, which we should be looking at, because nothing about Berkshire Hathaway is about the short term. Every investor in it knows this. Buffett has always looked, years and decades down the way. And so any investor in it has to know that there are periods of underperformance, and you have to be a long-term investor to have those all kind of even out. But over the last year, Berkshire B shares are up 10.4, and the S&P 500 is up 18.8. A lot of that underperformance has come in just the last couple of months, however. And then going out even further for the 5 years. So now we are getting a little bit out to where Buffett, would be like, you need to have a longer time horizon. Berkshire B shares up 126.3%, and S&P 500 up 91%. So it is still definitely outperforming in the 5-year stack. And that's why it got pretty expensive earlier this year. And that's when I did the other podcast. And I concluded on that podcast that it was just too pricey for me as a value investor to buy those shares. I was trading at like 25 or 26 times on a PE level. But even its other fundamentals, price to sales, price to book, were a little bit stretched and elevated. And I just felt you shouldn't chase there. And then maybe even Warren Buffett felt the same thing, because he has not bought back shares under the share buyback plan in 5 quarters now. And some of that, I'm sure, has to do with just the price of the stock. So I was looking around at various reporters, journalists, and what their take is on the various quarters that Berkshire has been reporting, because there's not many analysts that actually cover Berkshire Hathaway. There's just more journalists that cover them because it has so many components. It doesn't really make sense. You would have to be, and there are some who are just an analyst on Berkshire Hathaway. And then the way the company operates, we don't always get all of the information. And so it makes it very difficult to model Berkshire Hathaway, to even know what the earnings might look like with all the different components. And so they don't really even try. There are a couple that do put them out, but it's just very difficult. So it's better to look at the journalists for various organizations. I looked at one who was at Forbes, who just kind of specialize in Berkshire Hathaway and what's going on there. So they do nice write-ups about what is going on every quarter at the annual meeting, anytime Buffett gives an interview, all that kind of thing. And so you get some good information in there. And they were saying in one that I read in Forbes that Berkshire has historically purchased when the price to book ratio was less than 1.2. Now, I look for price to books at 3 and under. That's usually where you can find value stocks. So 1.2 is pretty low, but the stock has been a lot higher over the last couple of quarters. In fact, when it was hitting new highs earlier this year, it was around 1.8. So if he only wants to buy at 1.2 or less, then obviously 1.8, he's not buying. So he didn't. And current price to book is 1.5. We just did get the second quarter earnings results. Once again, they did not buy any shares. So at 1.5, he's not buying. Also, even though the stock has pulled back, it hasn't pulled back enough for the stock to get cheap enough for him. And for me, it really kind of hasn't either. I'm still waiting for it to get a bit cheaper on all of these valuation metrics. What do some of the other ones look like? It's PE, price to earnings, has come down because the price has come down. And so it's now trading at 22.9 times. It was at 26 times when it was peaking a couple of months ago. So that metric has come down. As I said, the price to book is now at 1.5. Price to sales ratio, though, is pretty elevated at 2.7. And then we have a PEG because those earnings are expected to be down this year. The PEG is at 3.2. So we're not really getting a growth factor this year. And so on the estimates, the Zacks consensus has earnings falling 6.7% this year. They made $22 a share in 2024. This year's estimate is calling for $20.53. And then 2026, a little bit of a rebound at $21.56 for 2026. So basically an extra dollar for 2026. A lot of the analysts look at operating earnings for Berkshire because it's got just, the huge cash component now, the equity side. And so why not look at operating earnings to really see what the actual underlying businesses are doing? In the second quarter, it fell 4% year over year. And then they did have to take that write down of $5 billion on the Kraft Heinz investment. And that's been talked about for years, that he admitted he overpaid. Yes, even Warren Buffett can make mistakes. He overpaid for Kraft Heinz, and now he's finally starting to write down a bit of that. And so then that's how we got the $5 billion. Now, of the business units, insurance is still the largest industry that Berkshire Hathaway owns. 16% is in underwriting and 30% is in investment income. Then, of course, he has the railroad. That's 13%. That's BNSF, the railroad. Then he has the energy, Berkshire Hathaway Energy, which owns a bunch of things like U.S. utilities and pipelines. That's 9%. Another huge area is kind of all lumped together in manufacturing, services, and retailing. That's 32%. So the insurance wing is really 46%. Manufacturing, services, and retail is 32%. And then they have this other category, which is very small. It's like less than 1%. It shows up as 0% on the little chart, but it's less than 1 because that's where they stick things like their share of Occidental Petroleum. They now own 28.1% of Occidental, and that shows up in that little category. But within each of those is a lot of things going on. So each one of the businesses in there has their operating income, right? So it's a lot of moving parts, as I said. And the area that did hurt them in the second quarter was insurance on the underwriting side, because last year was so good for the company on insurance. And so they're lapping last year, and that's very difficult to do. And it was going to slow down because it was so good last year. So that has slowed. But the BNSF was actually up 19% year over year. The energy, BHE, the Berkshire Hathaway Energy, up 7%. The manufacturing, services, and retail was up 12%. The underwriting, again, that was their troublesome place. It was down 12%. And then insurance, investment income was up, but just 1% there. But there's so much going on, even if you start to dig in underneath each of these categories, right? So they have in the manufacturing and retail area, in that big segment, which was 32%, building products and industrial products are the two biggest areas. Industrial products is 39%, and then building products is 22%. Then they have just services at 16%, and then consumer products, 8%. I'm assuming that's like See's Candies and Dairy Queen, maybe. Retailing is 8%. That might be See's Candy, actually, under retailing. But that is, the Furniture Mart, Nebraska Furniture Mart, perhaps as well. And then they have Pilot. Remember, they bought a share into Pilot. Now they bought it outright. So now they own it outright. And that is 3% of that category. And then they own McLane. I haven't talked about them in a long time. A lot of people don't even realize these companies that Berkshire Hathaway owns, right? So McLane is a supply chain type of company. They used to be owned by Walmart. They have been bought by Berkshire for over 20 years now. Walmart remains one of their largest customers, but they also supply to convenience stores, wholesale clubs, military bases, fast food, casual restaurants. It's food and beverages, and I'm not sure about other items. Circle K, the convenience store, is one of their customers as well. That area, that company has 25,000 employees. And the only info I could find on revenue for them goes back to 2017 when apparently, according to Wikipedia, it was 50 billion. So I'm not sure what it is now, but it's got to be higher. And on the second quarter, earnings for McLane up 23.9% as gross margins rose, but so did SG&A. So it was offset a little bit by SG&A for McLane. And then you also have on the manufacturing side, you have Marmon. I've talked about Marmon in the past on the podcast when I'm talking about Berkshire, because they basically own about 100 companies in manufacturing and services. That was up 6.9% on the pre-tax. But the operations, the results from all of those companies in there were somewhat mixed. So if you're a retail analyst or if you're an analyst on Berkshire Hathaway, not only do you have to deal with all of these segments that I'm talking about right now, but even the segments have segments. So even Marmon as a standalone would be hard enough to figure out what was going on there with all those companies that it owns. So you have a conglomerate that owns a conglomerate kind of in there. And so it's pretty nuts. Pilot, let's see what they did. Travel centers, that was not a good quarter for them. They saw a decrease of 40.2% due to lower gross sales margins and higher SG&A expenses there. Nebraska Furniture Mart was actually pretty good, and so was See's Candies. And they cited some seasonality at See's Candies. Berkshire Hathaway also owns in the services Berkshire Hathaway Automotive. Remember when they bought the auto dealers? So these are like Lithia, Penske, Asbury, but they only own 80 auto dealerships. They bought it from like a family-owned company, which is kind of like what Lithia is. But Lithia is much bigger than 80, but 80 is not super small. And a lot of the auto dealerships did well in the second quarter. So I'm not surprised to know that earnings were up 8% for Berkshire Hathaway Automotive as well. The services group was up 15.2%, and they said due to aviation services, leasing businesses, and the charter brokerage. So that was good. Building products. Let's talk about that one. It's struggling. Not surprising because of what's happening in housing, right? Other sides of building are doing pretty well, but housing not good. And so they did say they're seeing lower consumer demand and pricing pressures due to the housing market and the slow housing market there. Clayton Homes, better revenue, but lower pre-tax income due to lower earnings from financial services. And that might be on the lending side. Obviously, they have a lending arm there too. So a lot of mixed things going on in all of their segments here. And so not surprising, the shares are a little bit weak here. They didn't really talk that much about tariffs that I saw. So that might not be hitting them that hard yet, but anything in like the energy pipelines, you're going to be using steel, aluminum, copper. Even Clayton Homes is going to be using items. I'm not sure where they're sourcing from. That's the thing with a lot of their businesses. Where are they sourcing? I listened in on the Kava group conference call, and that's the Mediterranean fast casual, I guess, fast casual chain. And they are seeing some tariff hits because they do source some items from outside the US. It's not big, and they're accounting for the tariff impacts so far. But if even Kava is what's happening at some of Berkshire Hathaway's food items and all of its other companies, so you don't really know where the tariff impacts are going to hit. And even in the second quarter, a lot of the tariffs had not actually been put into place yet. Maybe the 10% on a lot of countries, but the bigger 25% or even 50%, like we're seeing on Brazil and in India, were not in place yet in the second quarter. So we'll see how that hits as it goes along. Now, what about the company's cash holdings? That's the thing everybody wants to buy with Berkshire right now, I guess. It's up to 29% of the company now, the full kahuna, 29.6. That's the highest it's been. And then if you look at a chart of where the cash position has been, the last time it was over 20% outside of this cycle, because it's taken a little bit of time to get to the 29.6, right? So the last year or two, it's been moving up. But the last time before this decade when it was over 20% was in 2003 to 2005. And it never got up to 29.6. I'm not sure. I don't think it even got past 25, but it did spike up then. And then, as we know, Buffett did use it to deploy during the financial crisis and got a lot of deals in there and got some stocks at cheap levels as well. So the key thing for a company like Berkshire Hathaway is to have cash on hand for when the dark times come, because it can deploy that to get some real good deals for the shareholders. But we now have Warren Buffett, who won't be there to deploy it. Maybe, maybe not. He still will be on the board, so we'll see. But depending on if the deals come in the future, he may not be there for that. So the street is starting to ask, do we trust Greg Abel? Do we trust any of the other leadership at Berkshire Hathaway to do what Warren Buffett has done? Well, obviously, there's only one Warren Buffett, and there was only one Charlie Munger before that. And even before that, there was really only one Benjamin Graham. And so when you do get these rare, unique investors, it is very difficult to replace them. We've seen some of this at other companies like Apple, which lost its leader in Steve Jobs and did replace with Tim Cook. And now we've had a number of years with Tim Cook at the head. So, but that's a little different because he's running, the basic company there and not a huge investment portfolio. So on the investment portfolio now, 52% are publicly traded stocks, 44% in cash, 3% fixed maturity securities on that side. And they now have $344 billion in cash as of the second quarter. That's down from the first quarter, which was $347 billion. But so it's down $3 billion quarter over quarter. But still, this is the biggest amount of cash they've ever held, and nobody knows what are they going to do with it. Are they going to give it back to someone? Are they buying something? And this is why the doubts begin to creep in about what's going to happen to Berkshire Hathaway, because again, they thought Buffett will know how to deploy it. He knew how to deploy it during the financial crisis, but will the others know how to deploy it? So we await to see, but is the stock cheap enough now for investors to maybe take a chance and get in? I would still say no. Like I said, no earlier this year, because of the valuation is still a little too stretched for me. And there are risks here. There are risks on the tariff side still with Berkshire. And then also in a recession, its businesses are impacted. Dairy Queen will be impacted. Nebraska Furniture Mart, Clayton Homes, everything basically will be impacted in their business model, as everything is when the economy slows. So if you look at a longer chart of their operating earnings, you can see in the recessions, operating earnings pull back. They've started to pull back a little bit here in 2025, but we aren't in a recession yet. Is it a sign? Is it signaling that maybe one is coming? I feel like I could get the stock cheaper in even the next 6 months than what I'm looking at here. And it doesn't even have the growth component. Now, whether or not you want that cash, that is another question. But you can also just deploy your own cash, right? You don't need to buy Berkshire just to get those cash holdings in that cash position. So Berkshire, brk.b, I'm still on the sidelines here, but I am watching it closely. And I'm going to be watching every quarter now to see if it's signaling, that the greater economy is going into recession. It doesn't have the tech exposure, but it definitely has energy and manufacturing, some of the services side, and the consumer, which makes up a huge percentage of the economy now. So Berkshire Hathaway is kind of a window onto certainly the old economy of the United States, but also the consumer side of the economy. So I'm on the sidelines, and we'll wait and see kind of what happens over the next couple of months, as I mentioned, but Berkshire Hathaway hasn't reeled me in yet. And I do think some of the premium of owning it has now or is in the process of going away as the market and the street adjusts to the reality of Buffett not being the one to make the decisions and having no idea what anyone who will be making the decisions is really going to be doing at the company. So we'll be doing more on Berkshire as the months go by, and certainly into 2026 when Greg Abel actually does take over. There's going to be a lot going on. So make sure you subscribe to get all of our podcasts here. And those growth stocks, they're running again, but I am able to find some good value stocks are still out there. It's not all growth right now. And there's even value stocks with growth, as I've covered here on this podcast. So be sure to get us on Apple. We are on YouTube as an audio podcast. Go to Zach's Podcasts to get all of our audio podcasts there, including ETF Spotlight with Nina's and her great podcast as well. But be sure to get us somewhere, and I will see you again next week with some more value stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.